Tools of monetary policy, the discount rate. This is tool number 3, called discount rate, or if for short for discount window borrowing. So banks can also borrow from the Fed if they need additional cash, and they will pay the discount rate. So here's an example. The Fed is going to lend US Bank 1 $1 million, and in a very short amount of time after that, the US Bank will repay the $1 million plus some interest, which is determined by this discount interest rate. That the Fed will set the discount rate above the federal fund rate. That way, it will create a maximum or ceiling interest rate for borrowing. Right? So the banks are most likely to borrow from other banks at lower rates. They will only pay the discount rate if they have no other option. And that way, the Fed can control the lending and the borrowing. Here's an example. This bank has the option to borrow money from the Federal Reserve and pay a discount rate of 5%, or borrow from another bank and pay the federal fund rate of 3%. So it is to their advantage to borrow from another bank and pay the federal fund rate. So the discount rate is sort of like the last resort. And by changing the discount rate, the Fed can encourage or discourage lending. If it wants to encourage lending, it's going to lower the discount rate so that banks have more options to borrow at lower rates. So this is how the interest rates are structured in the economy. The minimum interest rate is going to be the interest on reserve or overnight reverse repurchases. And then you have the federal fund rate, which is the rate at which banks borrow from each other. And then on top, you have the discount rate, which is the interest rate that banks can pay if they want to borrow from the Fed. And then all the other interest rates are above that. So the interest on reserve is the minimum interest rate that banks can earn. And the discount rate is the highest rate at which banks can borrow. So all the borrowing and lending activity of banks happen in between these two rates at the federal fund rate. Banks can borrow from each other and pay the federal fund rate, or they can earn it from each other. Right, so the Fed is setting a minimum that the banks can earn and a maximum at which they can borrow. So let's assume that the Fed is raising the interest rates. So it will raise the interest on reserves, it will raise the discount rate to force the federal fund rate to also go up. Right? So the federal fund rate now, instead of being between 3 and 5%, it's going to be between 4 and 6%. And this means that all the other interest rates in the economy will also increase. So by adjusting the floor, which is the minimum interest rate, the interest on reserve or overnight reverse repurchases, and the ceiling, which is the discount rate, The Fed can influence the borrowing and lending, and by influencing the cost of borrowing, it is influencing economic activity. If the cost of borrowing is high, then there's less incentive to invest or buy big ticket items. And so consumption goes down, investment goes down, economic activity goes down, and employment also can go down. If the Fed wants to increase economic activity, then they will try to reduce the cost of borrowing so that more economic activity takes place and the employment would increase.